Welcome to the Daily Update, where I'll go over the action in the market for Thursday, January 25th, and then we'll see how things look for Friday, January 26th. We had an update for the S&P, which again set another new all-time high, so that's positive. We are still looking overextended to the upside, but as I've been trying to point out, that can last for a period of time when we're in a more positive environment. There was positive reaction to the GDP report that came out. Now, on Friday, we're going to get another inflation report that's pretty important. We'll see how the market reacts to that. We did see where the broad market had a little bit more of strength compared to the mega caps. So for right now, we're still looking okay. Nothing too major to the upside. We're not really seeing what we sometimes call a blow off top, where we just shoot higher with all reason flying out the window, and then people start selling into that, and before you know it, we turn and go the other way. We don't see that happening, at least right now. So let's go back and talk about what happened. Right at the open, we did have a gap higher open, and prices climbed above R1 at 48.93. So now we're dealing with that 4,900 level again. Prices then declined down to the daily pivot at 48.79. We got down to the unchanged level, which on an up day is that built-in support level. Then we rebounded up off of that back to the daily pivot, and we closed at R1. So we saw some weakness a little earlier in the day, but then some strength going into the close. We were up 0.53% on above average volume, and we are positive with our technicals. In Friday's session, it'll be about the PCE report that's coming out. That is a very important inflation reading that we're getting, and one that the Fed really uses to focus in on whether they're going to raise interest rates or not. So there's probably going to be some reaction to that. Of course, we want to keep an eye on the different geopolitical events. Some comments that we can make: there's another all-time high now for the S&P, the Dow, and the NASDAQ 100. The S&P is still dealing with resistance at that 4,900 level. We've not been able to close above that. The broad market did outperform in Thursday's session. Discretionary is still a problem. It's under a lot of pressure right now and really underperforming, and I'll show you that chart near the end of the video. And it has a lot to do with what's happening with Tesla, since they're a big company and they have a real impact on the discretionary sector. Here's our short-term list. It's about the same as what it has been over the last few days, with the Stochh RSI, the Williams percent R, the CCI 14 and 20, and the stochastics. Those are the usual charts that we see. The standard deviations chart, we're back up into that +3 channel now, and the RSI based on 9 periods. We still have a fairly long list in the intermediate term that are looking extreme positive, or you could say overbought. We still have the CMB composite, the rate of change going back 50 periods. Our oscillators, some of them, they're looking better and they're turning back more positive, but they're getting back up into an extreme positive reading. The Sean trend meter, the RSI based on 14 periods, the bullish percent index for both the S&P 500 and the NASDAQ 100, and then our longer term new high, new low study for the S&P. On a long-term basis, we still have our 150 and 200 period simple moving averages. This list really hasn't changed. There's a few things that come off. We had the percent B come back on the list after Thursday's session, but for the most part, we're not seeing an awful lot of change right now. We're just kind of sustaining where we've been at, and we're dealing with this current scenario. Friday, hopefully, will shed some light on that to give us an idea. Is the Fed actually done raising rates, or are they going to have to come in and raise rates? Are they going to lower rates at some point? For right now, it looks like they're just going to keep rates where they're at. The market is still kind of holding out a bit of hope that maybe there'll be a rate cut in March. That's probably too premature, but they are looking at the possibility of rates being cut later on in 2024. If we come in really strong, the Fed did say that they would come back in and actually raise rates. So we're kind of maintaining that balance between the two. The dollar was up and interest rates were down. We closed at 4.13% for the 10-year yield. That's still above the 4.02% that starts to bite into corporate profits. We still have the 10 to the 2 and the 10 to the 3-month yield curves that remain inverted. We're still extreme positive with sentiment. We ticked above 75. We got up to 76. Now we're at 77. This is when we want to start looking at, okay, we need to get prepared to use this as a contrarian indicator, because based on this reading, we're getting a little too extreme positive. And we're looking more positive with our trend. We're actually starting to show a new trend, and that trend is positive with our ADX. It's now going above the moving average, both in the short term and in the intermediate term. Our bias is positive since we had an up day, and then the last 2, 3, 4, 5 days together are positive with our momentum. The economic reports that came out, and there's quite a list here, but I don't have charts of all of these things to show you. The big one was real GDP. Real means you're taking inflation into account. It came in at 3.3%, much more than the 2% they had expected. Now, the market could have freaked out on this, but this is the big measure of the U.S. economy, and to have it growing stronger than expected was taken as positive, even though it was down from the 4.9% growth that we saw last time. The GDP price deflator, this is what the market reacted to. They expected it to come in up 2.8%. It came in up 1.5%. Last time it was up 3.3%. The market liked that. It's just showing, okay, inflation's under control, and we're seeing fairly good growth right now in the economy. The weekly jobless claims really spiked up. They came in at 214,000. They had expected 200,000. The continuing claims also ticked up to 1.833 million, where last week they were at 1.806 million. Durable goods orders came in unchanged. They expected it to be up 0.1%. Last time it was up 5.5%. When you take out transportation, we were up 0.6%, which was greater than the 0.2% they had expected. Last time it came in up 0.5%. These are the charts that I won't, or the statistics that I won't show using charts. The advanced international trade in goods came in at a minus 88.5 billion. Last time it was at 89.3 billion. The advanced retail inventories were up 0.8%. They had expected it to be, last time it was up 0.1%. Wholesale inventories came in up 0.4%. Last time it was down 0.4%. New home sales came in up 8% on a month-over-month basis. When you project that out annually, it came in at 664,000 units, a little bit more than the 640,000 they had expected. Last time we had 615,000. On a year-over-year basis, we're seeing new home sales going up 4.4%. Here are some charts. Durable goods orders will show first, where we were positive even though we did tick down. We look at non-defense capital goods. This is when you take out aircraft, where we're showing a bit of a turn back up above zero. Here's the month-over-month change. Even though it was positive, it still really decreased from the previous reading. Then we look at real GDP and the deflator. The blue line is GDP, where it came down a bit from the previous time that we had this reading, but it's still positive. It's above zero, and the deflator is also continuing to go down, and the market liked that. Personal consumption is pretty much flat right now, but it's still positive, so people are still buying things. The net exports are still negative, and we're kind of showing a little bit of a decrease in this. Real GDP on a year-over-year basis, we're showing some growth here when we project this out a little bit. Nothing really, really strong, but at the same time, it's still showing some growth in the economy. New home sales ticked back up and are showing some more strength here. The 3-month average of the new home prices continues to decline, and some of this has to do with interest rates going up. Housing prices had been really high. People are not able to afford to buy a house, so they have to lower the prices, and that's what the general trend has been, at least over the last year to 2 years. Here are the weekly jobless claims, where they did really spike up, but we're still seeing the 4-week moving average continue to decline. We also saw a bit of a spike up with continuing claims, but the moving average is still declining. We look at all of this together. The blue line of the continuing claims, it's kind of hard to see, but it ticked up here. We're still at 3.7% with the unemployment rate, and it's hard to see this way too, but we did turn up with the initial jobless claims. One chart to show you here, this is the earnings per share against the trend. This is what they're projecting going forward. And this, again, as I always say, is justifying stock prices actually going higher. Here's our intraday chart, where we gapped higher, and we saw a little bit of a wider spread between the pivot points here. and we were able to get a little bit above R1, and we just trailed sideways. Then we started to see some weakness come in. We got down to the daily pivot, broke below that, came down to the unchanged level, and this is when we saw some buying coming in, took us back above the daily pivot, and we closed pretty much at the high for the session. So not a real move in trend because we kind of finished near where we started, but it ended up being an up day. Here's the intraday chart where we were positive before the market opened. We saw most of the strength after the GDP came out, and then a little bit of trailing off, and then some strength going into the close. We're going down just a little bit in the initial overnight session. And we did see growth not do as good in Thursday's session. That's the blue line where we saw value start to come up and cross above the blue line. We want to keep an eye on this. We want the blue line to be on top, and that helps the indexes to actually go higher. Here's the intraday chart with the growth to value ratio showing how growth did underperform. We've been watching this general trend going back to about January 8th, where it's been showing some improvement, but it doesn't mean it's going to do great every day. Is this just some kind of an anomaly here, or are we beginning something with this? Our end of day charts, we were up with growth, but quite a bit less than we were with value when we look at the large caps. Up a little bit more with the mid caps and up about half as much with the small caps. So they were up, but not up very much. We ticked down just a little bit with our growth to value ratio for the S&P, but in the bigger picture, we have been seeing some improvement. Here is discretionary that we're keeping an eye on, where it's just not showing a lot of strength right now. When we look at the equal weight ETF, the staples equal weight ETF did tick up, and we came up just a little bit with our ratio here. But as I've been trying to point out, as the S&P has been going up, that's the top part of the chart, we're seeing a negative divergence when we look at this ratio at the bottom of this chart. We want to see this really going up, and that's just not happening. Here's our trend. We're crossing above the moving average with the ADX. This is our intermediate term trend analysis chart. We do have the green line on top, even though it did decline. So we would default to positive. We're crossing above the moving average in the short term. The green line is also on top, but coming down, but we would still default to positive there. We are going back above average with volume when we take the last number of days together. So that's showing a real improvement. Here is sentiment. We were pretty much flat with the Ulcer Index, and we're getting a very low reading here, showing that there's just not a lot of fear. We did tick up a little bit with the VIX on the line chart as well as the bar chart. This could be some activity going on ahead of the inflation report and reaction to the GDP report. We're seeing the VIX of the VIX pick up just a little bit as volatility had become very, very low. Now it's starting to go back up slightly. Here's the equity put call ratio, where it was pretty much flat after it did bounce. As I pointed out yesterday, this could have been some hedging ahead of these two economic reports, which are also coming out before a weekend. So folks may have been putting some more puts on their long positions. But when we look at the 5 period, we are continuing to decline. We spiked up and we're coming down, and that is typically positive for the market. We're keeping an eye on the skew index. Where the VIX measures at the money options, the skew index looks at out of the money options. We're not quite up into this red area, but we have been climbing here. And this is when the market anticipates some kind of a move. Now, sometimes that's to the upside, sometimes it's to the downside, sometimes it's a continuation. We need other charts to give us some context. But when we get up into this red area, spike, and then come down, that just typically means something can happen. We don't really know by looking at this chart whether it's going to be positive or negative. We did get the latest reading of the American Association of Individual Investors. They dropped off a little bit with how they're feeling about things. But when we look at the red line, which is the moving average, it's continuing to improve and it's still above zero. So we're not getting any extreme readings based on sentiment of this chart. Our advanced decline studies, we did tick back up based on price. We also showed some improvement based on volume, but we're still seeing this negative divergence. Based on price, we're coming back up to this previous high. We haven't been able to come back up to this previous high based on volume, at least yet. We're actually starting to decline a little bit with our 5 period new high, new low study. We are seeing many more new highs than new lows. That's why this is giving us a very high reading. But when we look at our 10-day average, we are continuing to go up, so that is positive. We declined, but we're still above zero with our advanced decline ratio. We turned back up. This could be encouraging with our accumulation distribution. This is a smart money indicator. We also ticked back up just a little bit with the Chaikin money flow, another smart money indicator. So when we look at our Chaikin oscillator, another smart money indicator, it ticked back up just slightly after it had been declining. Looking at our advanced decline line studies, we showed some improvement with the common stock for the NYSE, with the S&P, the mid caps, but still not back to this previous high. We saw a bit of a bounce here with the small caps, but it has a further ways to go here to get back to this previous high. Looking at the daily chart, where as we keep going up, we still set new all-time highs on a closing basis. On the bottom, we're seeing volume start to consistently be above average. No changes in the decision point scorecard. We're still extreme positive with most of our short-term indicators with the Stochk RSI, the Williams percent R, the CCI 14, and the CCI 20. We showed some improvement with our 20, 50, and even 200 period moving average study, and we're not getting extreme, at least yet. We did bounce up a little bit with the force index. We're above the midpoint. The midpoint itself is actually going up, so this is positive. But we're still extreme with the stochastics in the short, intermediate, and long term. We're up into the +3 channel for our standard deviations chart, so that is extreme positive. The balance of power continues to go back up and is above zero. This is positive. We're still positive with the go, no-go trend-based system. And our highest high value continues to go up. The midpoint is also continuing to advance. That's positive. The TTM squeeze is showing some improvement with the lighter shade of blue. The CMB composite is still extreme positive. So that's another thing to just be aware of. We are positive with the ease of movement based on 14 periods. We're above zero. In our room, it's pretty much flat right now. It's positive when you take the green line and the red line together because we are above zero here. And we're seeing some improvement with the S&P McClellan oscillator, but we're still below zero. So when we look at the summation index based on price, this goes down when the McClellan oscillator is below zero, and that's what we've been seeing. We're coming back down to this red line here, but on the bottom, we're starting to turn up now based on volume. Sometimes, and these are two different indicators that are plotted on the same chart. Sometimes this does give us a leading clue as to what's happening. Especially, we've been concerned a little bit about what's happening with volume lately. The fact that this is turning back up could be more positive. But when you look at the broader market, the NYSE McClellan oscillator, we've crossed back above zero. So that's more encouraging. And we're just barely starting to turn back up based on price, but we're still declining based on volume for the NYSE summation index. The Swenlin trading oscillator is still looking more positive. We're above zero and advancing based on price and volume. We're turning back up with the PMO, but we're above this red line, which means we're already extreme positive. We're showing some improvement based on price and volume, but those still continue to decline. We're showing some improvement with the PMOs that are rising. We're also showing some improvement with the buy signals. We're still extreme positive with the PMOs that are above zero. We continue to be positive with the Elder's Impulse system for the S&P. Also, we're positive with the parabolic SAR. The slope oscillator is turning back more positive here, and we're not too far away from this extreme positive reading, but we could go well above that like we did back in November, and then we stayed above it for most of December. These are just guideposts to give us some ideas. The MACD is also looking back more positive. So the slope oscillator, which I just showed, that's short term, where the MACD is more intermediate term. So looking at all of our oscillators, we are showing some improvement in the short term. We're above this blue line here with the TSI, so that's extreme positive. We're turning back up with the MACD, the PMO, and the PPO. We're showing some improvement with our long-term oscillators, the TRIX and KST, but we haven't quite crossed above the moving averages. We're above all of the plotted moving averages in our moving average tree, and the lines are smoothing out and continuing to go up. So that's just showing a good solid upward trend. The bullish percent index, we're kind of dancing right around this 70 level here. We did get back above it. Now we're starting to drop down below that just a little bit. We were pretty much flat with our NYSE bullish percent index, but we're positive because we're above 50. And we continue to go up with our NASDAQ 100 bullish percent index, and we are extreme positive here. The money flow is above 50 and advancing. That's positive. The ultimate oscillator turned back up and is above 50. That's positive. The vortex has the green line on top and advancing. That's positive. We're getting extreme with our RSI based on 14 as well as 9 periods. On balance volume, now this is one of the first technical analysis indicators to be developed, and it's a little bit misleading. It was developed by Joseph Granville, and I like to point this out from time to time. If we have an up day, all of the volume counts for positive. If we have a down day, all of the volume counts for negative. And that's why we see these pretty big moves above the moving average that is advancing, because even though there was some selling that took place, it all gets counted as though it were buying. Just something to be aware of there. We showed a little bit of an improvement with our 250 period moving average studies for those stocks in the S&P 500. The Copic curve continues to be positive. The rate of change, it declined, but it's still extreme positive. The Sean trend meter is getting quite extreme now. And we're just barely extreme with the percent B indicator because we closed slightly outside of the upper Bollinger Band. The boom indicator is looking a little bit more extreme. We're already above and looking extreme with the 20 period moving average study. And this measures how far away are we from the moving averages, because once we get too far away, price has a tendency to bounce back to the moving average. And we're also starting to get extreme with our 50 period moving average study. We're still positive and not extreme with the 200 period moving average study. Don't have any Fibonacci and line studies. I may take this slide out of here for a while until something starts to develop. But when we look at the trend, the Heiken Ashi continues to be positive. The Kegi chart is positive. The Renko has redrawn and is looking more positive. And the 3-line break is positive as well. Long term, we're still looking extreme positive with our 150 and 200 period moving average studies. And we've been that way, well, since about halfway through December, all the way now into starting to get into the latter part of January. We did see some improvement with the equal weight index when compared to the S&P, because the broad market did participate. So when we look at our ratio, that did decline slightly. This is a longer term negative divergence, and I've taken it off the slide at the very end of the video. This is turning into a longer term negative divergence, and so I'm going to put it on the long term list. But I watch this every day, and if things do change, I will be certain to bring that up. And the transports are still underperforming the Dow. The Dow did have another update, and it just barely closed with a new all-time high. The diamonds continue to be positive, and we're still above this pivot point for the NASDAQ. And it was up slightly, nothing all that great, but it still had an up day. We also had the NASDAQ 100 finish with an up day here. We're above this pivot point. We're not falling apart at this point, but we're not seeing an awful lot of strength. Right now, it looks like the market is a little bit tired. It's going to need something to push it higher from here. And it could be the inflation report that comes out on Friday. But we're still positive on a trending basis when we look at the QQQs for the Elders Impulse system. The momentum for the NASDAQ 100 continues to be positive. The small caps were still above this pivot point. They were up almost 0.75%, but we need to see a lot more than what they've been doing. We continue to be positive with the Elders Impulse system with the small caps. We're still below this pretty significant resistance level here for the Russell 2000 small caps. We're above 50 and advancing with the RSI. We are positive with the trend. We're negative, but showing some improvement based on the momentum of the Russell. The mid caps also were up a little over 0.5%, and for the last few days have been chopping sideways. They continue to be positive with the mid caps looking at the Elders Impulse system. We didn't set a new all-time high with the FANG index, but it's still looking like a pretty healthy chart. The financial sector was up 0.5% and is showing a lot of improvement. The dollar ended up being up in the session, even though we're still dealing with a longer-term downtrend. We ended up declining with the 10-year yield. We advanced with the 10-year based on price. And then looking at our growth of value studies here, The Qs, the S&P, because the mega caps didn't have a really strong day, we turned down a bit, but we're still above the moving average. This is the concerning area. Discretionary is really underperforming the S&P. We turned down just a little bit, but we're still positive when we look at large cap growth to large cap value. So looking at our different indexes here, the growth to value ratio declined with the large caps, mid caps, and we came down almost to the moving average with the small caps. The 10-day average of the S&P 500 highs minus the lows were still extreme positive, even though we're starting to come down slightly. And we're still above zero with our 5-period moving average of the highs minus the lows across the broad market. This is showing some improvement. The longer it can stay above zero, the more positive it will be. We did decline a little bit with the 2-year yield. That is giving some support to the S&P 500. We're continuing to decline, even though we ticked up with our Staples to S&P 500 ratio. But overall, this has been declining, which typically helps the S&P. So what's our outlook for Friday? We're wondering about this whole January effect. And is it going to make some kind of a reappearance here? We're still positive, showing some improvement, but we are overbought when we look at our technicals. We're going to get personal income and spending, as well as PCE prices in Friday's session. Keeping an eye on all the different geopolitical events, but they just don't seem to be having that big of an impact on the market right now. Here's the economic calendar, which will be finishing up in Friday's session. Looking at seasonality for January 26, we're neutral to positive with the Dow, neutral to negative with the S&P, and we're more positive with the NASDAQ 100. We will be in the last trading day after options expiration week, where we tend to be up almost 60% of the time and down about 40% of the time for the week. Here is the seasonal chart put out by Carson. Hopefully this will be updated fairly soon. We will be on the 18th trading day of the month, where we do see a little bit of positive seasonality for the S&P during an election year. Wondering where we're at with this whole January effect with the small caps. And this is also showing where we continue to chop more or less sideways when we're dealing with election years. But be aware, we seasonally anyway do see some weakness as we get a little bit further into the year. We're also pretty much going sideways with the Stock Traders Almanac. We do see some weakness before we see strength after that. And this is when the current president is running for re-election. We are looking a little bit better when we compare this to the green line. We will be in Friday's session, which tends to be the second most positive day of the week, at least based on the data that happened in 2023. So our scenarios can't go with the down one, even though we are overbought. If anything, we would go with the up scenario, but be aware, we are overbought and looking a little exhausted right now. We're not going with the neutral or sideways trend because our ADXs have both crossed back above their moving averages. That suggests that the trend is strengthening. The warning signs. I haven't been showing the risk on, risk off chart for a while. It's just chopping around for the most part. And we're still seeing that longer term negative divergence between the transports and the Dow. Growth is still showing some improvement, even though it didn't do all that well in Thursday's session. The 5-period equity put call ratio is still declining. That often is positive for the market. The oscillators are improving, but be aware, we do have a few that are already looking extreme positive. The parabolic SAR and the vortex charts are still positive. The bullish percent index for the S&P and NASDAQ are positive, but looking extreme positive. The Copic curve is positive. The momentum for the NASDAQ 100 is positive. And our small and mid cap growth is positive, but it's been chopping sideways, even though they did come down in Thursday's session. The financial sector continues to be positive. So our conclusion, we're positive. We continue to show improvements as we have up days, but we are overbought. And that's what we're focusing on in the short term, because that will eventually bleed over into the intermediate term, where we're also showing a lot of overbought indications. And we're positive in the long term because we're above the 200-period simple moving average, but those longer term moving averages that we're looking at continue to be extreme positive. Thank you. I really hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.